As 2025 ends, the stock market's biggest surprise isn't a tech giant, it's European construction stocks. These companies, usually seen as slow and steady, have outperformed, with the stock's construction sector index up a record-breaking 21%. Investors who bet on the basics, concrete, steel, and infrastructure, have been rewarded handsomely. So, what sparked this rally? It's not just one thing, but a mix of massive government promises, the looming need for rebuilding, and even the AI boom. Investors saw a future that needed to be built, aging infrastructure, new demands, and a world ready for transformation. The result, a rush into construction shares, lifting companies big and small across Europe. But, is this just the beginning, or a peak before reality sets in? Tonight, we'll break down the dreams that fueled this rally, and the risks that could bring it back to earth. This is more than a financial story. It's about the roads, buildings, and homes that shape our lives. We'll explore the hopes, the risks, and what experts are saying as we look toward 2026. The question, now, what comes next for Europe's unlikely market champions? Let's dig in. The story starts with a plan. Germany, Europe's economic powerhouse, has unveiled a staggering $500 billion plan to overhaul its infrastructure. This isn't just patching potholes, it's a sweeping modernization, from railways to green energy. The sheer scale electrified investors, signaling years of steady demand for construction firms. Companies like Holcim and Heidelberg, major suppliers, saw their stocks surge on the promise of future profits. The plan's ripple effect spread across Europe as firms everywhere eyed lucrative contracts. But here's the catch. The money hasn't started flowing yet. The 2025 rally was built on anticipation, not action. Investors are betting these grand plans will turn into real projects and revenue. For now, Germany's vision is the engine behind construction's record run. But a plan on paper isn't a shovel in the ground. The market is buying the dream of a rebuilt Germany. Will reality deliver? There's another more somber driver behind the boom. The devastation in Ukraine has created a massive, if tragic, opportunity. Rebuilding could cost over $500 billion, rivaling Germany's own infrastructure plan. Investors expect European firms to play a central role, given their proximity and expertise. Companies like CRH and Saint-Gobain are seen as likely leaders in this effort, but the timeline is uncertain. Reconstruction can't begin until peace returns. Global competition for contracts will be fierce. For now, Ukraine's rebuilding is a hope-fueling long-term optimism, but it remains a distant prospect. Meanwhile, other forces are at work. Strong cement prices have boosted profits for building materials giants, even before new projects start. The entire supply chain, from aggregates to steel, has benefited from expectations of a global infrastructure push. Investors believe a new golden age for heavy construction is underway. Then there's the AI boom. The explosion of data centers has created unexpected demand for massive, complex builds. These projects require huge amounts of concrete and steel, adding another layer of growth. The combination of robust pricing, infrastructure optimism, and tech-driven demand created a perfect storm for construction stocks. Each factor reinforced the others, making the sector hard to ignore. The result: record-breaking performance and a new spotlight on Europe's builders. But with every boom comes the question: how much is too much? Let's talk about valuations. After a historic rally, analysts are asking, have construction stocks become too expensive? The sector now trades at a hefty premium, about 15% above the broader market, up from just 6% at the start of the year. This rapid rise suggests expectations may be outpacing reality. The easy money, some say, has already been made. For stocks to climb higher, companies need to deliver real results, contracts, projects, and profits. If good news is delayed, these high-flying stocks could face a sharp correction. The rally was built on hope. Now, reality must catch up. Investors are watching closely for signs that the boom is more than just a story. The risk. If reality disappoints, the fall could be swift. Timing is everything, and that's the next big challenge. Let's look at when the work will actually begin. The biggest risk to today's high prices is time. Germany's $500 billion plan is impressive, but major contracts aren't expected until late 2026. Real construction volume may not pick up until 2027. That's a long wait for investors who've already priced in a boom. The gap between market excitement and real-world progress could lead to disappointment. Companies like Holcim and CRH, riding high on expectations, may see pullbacks if the wait drags on. Ukraine's timeline is even more uncertain. Reconstruction depends entirely on the end of conflict. Much of the sector's hope is tied to events with no set date. Both Germany and Ukraine are long-term stories, but the market has treated them as immediate certainties. The risk. A year of waiting, not working, could sap momentum. Investors need patience and a reality check. But there's another story emerging. As doubts grow around big infrastructure, attention is shifting to Europe's housing market. High interest rates had stalled residential construction, but with inflation easing, rate cuts are on the horizon. Lower borrowing costs are reviving demand for new homes. Developers are starting to build again, and early signs of recovery are visible. Analysts now favor companies exposed to residential and renovation markets, like Saint-Gobain, over heavy infrastructure giants. These stocks, long overlooked, are trading at a discount, creating a catch-up opportunity. As investors rotate from expensive infrastructure names to cheaper residential plays, share prices could rise. The story for 2026 may be less about mega projects and more about homes and renovations. Companies supplying insulation, plasterboard, and windows could become new leaders. This marks a shift from government-driven projects to consumer-driven recovery. The housing market offers a more immediate, tangible path to growth. For investors, it's a pivot worth watching. So, where does the market stand now? As 2026 approaches, the market is split between optimism and caution. Some, like CPR Asset Management and Kepler Chevreux, see falling rates and stimulus as a recipe for continued growth. They're bullish on both infrastructure and housing, betting the long-term story outweighs short-term risks. Others, like Invesco, urge caution. The rally was driven by hope, but now needs real results. High valuations and long timelines make them wary of another explosive year. They prefer companies with near-term growth, especially those tied to housing. Defense spending could add a bonus, but it's not a core reason to invest yet. The market's mood is a mix of hope and realism. The next phase will be about selectivity, not blanket optimism. Investors are weighing immediate opportunities against long-term dreams. The debate between infrastructure and residential plays will define 2026. The only certainty, the story, is far from over. So, what's next for Europe's builders? As 2026 dawns, European construction stocks stand at a crossroads. The 2025 rally was fueled by dreams, modernized Germany, rebuilt Ukraine, and the AI-driven data center boom. Now the market demands proof contracts, projects, and profits. High valuations leave little room for disappointment. The first signs of real progress, German contracts, Ukrainian reconstruction, housing recovery, will be critical. Investors must be selective. The era of buying the whole sector is over. The debate between infrastructure and residential leaders will shape the year. The potential for a multi-year boom is real, but so is the uncertainty. Europe's need for new infrastructure and housing is undeniable. The question is timing and price. 2026 will reveal if the rally was the start of a supercycle or just a market overshoot. For now, both builders and investors wait for the next chapter. The future is being built, one project at a time.